Understanding cash flow.
What do you think an entrepreneur would tell you if you asked him what the two most important words in the English language are? Sales, expenses, profits, bottom line? No, none of these. Ask 100 entrepreneurs the question, and 99 of them will give you the same answer: cash flow. As we'll be using the phrase here, it means, simply enough, the movement of money in and out of your business over a certain period of time. For someone with prior business experience, what you're about to see might seem a little obvious. For someone with little prior business experience, it might strike you as a bit too abstract. Stick with it. The time you spend watching and reviewing this chapter could be the most valuable investment you make in your new business. Over the long term, it will help you understand the engine that'll drive your business, cash flow. Right now, let's answer one of the most important questions confronting you at the moment. How much money are you going to need to get started?
Let's look at how to create a monthly cash flow statement. What we want to project is the cash we start with each month, what comes in, what goes out, and what's left over. We begin with your starting cash. Because we want to determine how much money you're going to need, we start here with a zero balance. Now we turn to our sources of cash in. We'll want to add any cash income, for example, from sales. Remember, we want only cash here. If you expect to make $3,000 in total sales this month, but only $1,000 is cash sales, and the rest will be paid to you in 30 days, we only want the cash you expect to receive. Payment that is due from customers but not yet received is called accounts receivable, or simply receivables. After your first month, you'll expect some of your receivables to be paid each month. So be sure to add these paid receivables to the cash in column on your cash flow statement. In our first month of business, in this example, we will have no paid receivables. Our total sales, therefore, are $1,000 received in cash. Other sources of cash income you'll want to add for the month might be from a bank loan or from interest on bank accounts. In our example, we'll say we have no other sources in month one. Then we simply add up these sources of income for a total of $1,000 cash in. Now let's move to the cash out column. Cash leaves the business in two basic forms. The first is called fixed expenses. These are expenses that must be paid regularly and can't be easily eliminated, such as rent, utilities, employee salaries, and payroll taxes, interest on bank loans, and so forth. You'll need to create your own checklist of expenses to run through each month. Are any quarterly taxes due this month? Any insurance payments? The second way in which cash leaves your business is in variable expenses. These are expenses which change from month to month, often varying with sales level, and which can be more easily cut or added to than fixed expenses. Variable expenses might include supplies, manufacturing, advertising and promotion, or consulting services. In our example, we'll say that variable expenses for month one are $300 in supplies. We now total up the cash out column to get $2,000 cash out in month one. Our ending balance for the month is calculated by simply adding our starting balance of $0 to total cash in, $1,000, and then subtracting the $2,000 total cash out. Our ending balance, therefore, is a negative $1,000. We also want to calculate our cash flow, the change between our beginning balance and ending balance. We went from $0 to negative $1,000, so our cash flow was negative $1,000 for this month. To begin month two, we take month one's ending balance of negative $1,000 and make it our starting balance for month two. Let's carry out this cash flow for 6 months. In order to determine how much startup capital you'll need, you must continue the cash flow projection until you're sure your ending balance is positive. For most businesses, we would look at cash flow for a year or two to be certain our cash flow remains positive. In our example, we'll assume this healthy business shows a reliable positive ending balance in month 5. We then look back over all our ending balances to find the largest negative balance. It's in month 2, a negative $2,500. This number tells us how much startup cash we need to keep the business going until we break even. That is, until all our expenses are covered and we're making money. Let's look at what happens when we redo our cash flow beginning with $2,500 startup cash. Our ending balance in month 1 changes from negative $1,000 to positive $1,500. Because our ending balance has changed, the beginning balance for the following month must also change. The new ending balance for month 2, which was our maximum negative ending balance, now becomes $0. We've used up all our cash, but we have also paid all our obligations this month. Let's see what happens in the following months. Remember, each ending balance becomes the next month's beginning balance. Month 2 is still our lowest point, but none of our ending balances are negative. We will have enough cash to pay all our bills and meet our payroll, provided that, and this is critical, our assumptions about the size of our expenses and the success of our sales efforts are in fact accurate. Note that while our beginning and ending balances have all changed, our cash flow has remained the same. This is because the actual flow of cash in and out each month has not changed. It is also important to remember that in a new business, it is typical for more cash to go out than come in during the early months. And this is precisely why it is so crucial to do a monthly cash flow projected for your first 2 or 3 years of business. You can find out what sales volume you need, or what level of expenses you can bear to stay in business. If you're not going to have enough cash, find out before you start. Perhaps you can adjust your pricing or cut your expenses. But you should make it work on paper before you go ahead.
I mentioned earlier that cash flow might seem a little bit abstract. Keep in mind that almost everything you do in the early stages of your business can have a major impact on your cash flow. Here are some tips on thinking smart when it comes to controlling your expenses.
Initially, when we got started, we kept our costs down by buying everything secondhand. I think we bought everything we could at the cheapest possible price. We didn't accept ever a first price on something. We always said, there's another price. Now, what is it?
It never hurts to use, boy, I'm just starting up. I don't have a lot of money, and I can't afford this, but I'd sure like this. It's just the old negotiating deal.
What's the opposite of expenses? No, it's not sales, it's income, which means getting paid for sales that you've already made. The fact that income and sales are not always the same can be one of the most difficult and most expensive lessons a startup can learn.
You're expending time and money yourself. You're paying the payroll. Every 2 weeks I'm paying this payroll. So it's really, terribly important that my clients will pay. So I'm not carrying them.
I didn't check credit on the customers that I did business with. I just shipped to them. And I was honest, and I expected that they would pay me. And I had a lot of people who didn't pay me the first year. I lost in bad debt 4 times my entire investment the first year.
In order to get paid on time, when it was very critical that I get paid on time, I told the truth. I said, I cannot afford 90-day net. I have to get paid in 30 days or I will belly up.
One final footnote. Earlier in this chapter, we talked about using your cash flow analysis to figure out how much money you'll need to get started. If that number looks too large, you're going to be very tempted to change the one variable that can have a major impact on your company's cash flow, and that's price. If you do that, remember that wishful thinking seldom works out there in the marketplace. Sure, you'd like to charge more, and if your product or service has a distinct competitive advantage, perhaps you can. But if it doesn't, your price will have to be lower. It's that simple.
Chapter summary. The survival of your business depends on understanding cash flow. Do a monthly cash flow projection for the first 3 years. to see if your business is viable, to determine the amount of startup capital you'll need, when you'll break even, and the impact of changes in your assumptions. Your cash flow will be affected by changes in expenses, in pricing, and in how fast you collect income. You can keep expenses low by buying secondhand, negotiating for the best prices, and keeping inventory low. You can improve your chances of being paid on time by doing credit checks, using payment contracts, and talking honestly with clients about your need to be paid. And finally, be realistic when setting prices in your cash flow projections.